Well, we talked a little bit about higher than expected inflation and maybe some slowing in the Chicago PMI. Is the Fed's challenge neither going to be inflation nor too fast growth, but something we remember called stagflation, perhaps?
Well, I think right now the bigger challenge is inflation. I didn't take that much signal from the growth numbers we saw this morning, particularly with a labor market that continues to add jobs pretty robustly. So I do think, what we see Friday morning is going to be a lot more important than what we saw this morning with respect to any stagnation in the economy. But absent that, I think job number one continues to be, as it has been for the past 2 or 3 years, continues to be inflation.
Why are you a little against the grain right now in predicting 3 rate cuts this year when many are retreating from that number to 2, 1, some 0? What makes you confident?
Well, we're a little on our heels, particularly after this morning's ECI number. But, we'll see if we do see any softening in the jobs data. We have had an unemployment rate that has been, on balance, drifting higher over the past year. If that continues, I think we could be on track for an easing sometime this summer or fall. But if we see the labor market, continuing or showing more resilience and less of a move up in unemployment, then I do think it calls into question whether they are going to be cutting any time in the summer or fall.
Michael, how do you think Jerome Powell handles questions tomorrow on the strength or weakness in the U.S. economy and how much weakness he is willing to tolerate just to get inflation down to 2%?
Well, I think one thing is he's going to sound a lot different than he did 6 weeks ago, right, when he kind of brushed off concerns about the inflation prints we saw in the first two months of the year. The third month really seemed to have changed the tune. I think on growth, though, however, he's been pretty consistent that they will react to unexpected weakness in the labor market. That has been, part of their story here for a while, except we just haven't seen any unexpected weakness in the labor market. So I don't think he really needs to modulate that message, but I think really where you're going to hear quite a difference is how he's talking about inflation. Sounding a little, quite a bit less confident, I think.
Yeah, he has started to do that as if to condition the market and the audience for what he might say tomorrow. That his confidence level that we're making sort of unimpeded progress toward 2% is less high than it was, right?
Yeah. So 2 weeks ago, he made those remarks. He also said that because of that, the rate cuts will come later than previously anticipated. So then I think what leaves, what the big question for tomorrow is he had in March said that the committee expects, rate cuts at some point this year, right? Maybe they're no longer expecting 3, but are they expecting any? I think that's another question he'll have to.
Is it interest rates that have troubled the market this past month? And what do you see heading into the future for equities?
Well, I'm not much of an equity strategist, but I do think clearly the pivot in the Fed has been something the market has had to digest over the past, I guess, really 3 months now. I think we are at a point here where, we've taken out a whole lot of pricing for this, a whole lot of Fed cuts for this year. So I still think the bar to hikes is going to be pretty high. And again, going back to Powell's remarks 2 weeks ago, he really said the decision is how long to keep rates elevated, not when to hike rates again. I think for that to happen, you'd really need to see a sense that the labor markets are tightening further and that wage pressures are building, inflation expectations are moving higher. But I think we're hopefully still pretty far from that point.
What is your take on the consumer right now, Michael? Just given that you're expecting 3 rate cuts this year, we looked at the consumer confidence data that came out this morning, a 21-month low. And then there's a report from McDonald's, which showed not only did profits come in light, but the company really stressed this point that the consumer is looking for a better deal. They may offer discounts on their menu. How do you size this all up?
So, first of all, the consumer spending data have been very strong, at least through March. Now, that's history. Going forward, there are some reasonable concerns about very low saving rates, credit card balances that are moving higher. And those are legitimate concerns. However, I think what's really going to, and not to sound like a broken clock here, I think it really does come back to the labor market. And if the labor market slows, the wherewithal for the consumers to keep spending like they have been in the first quarter of this year becomes more in question. But absent any slowing in the labor market, I think the consumer can continue humming along here like they have been so far.
Even if the housing market stays so strong and prices remain elevated, which we know is pricing out so many people right now.
That has been a problem. You are seeing And I guess you saw a reminder of that again this morning with rental and homeowner vacancy rates remaining super low. So that is a problem here. I think it's a structural problem that's probably going to take, unfortunately, years to correct.